So are you all there? Samar, Adarsh, who is there?
Yes, sir. Yes, sir.
Okay. So we will start in 2 minutes time since the break is at up to 10:40. So who are all there at the moment? Just
Sir,
release.
I'm there.
Okay, Vyam. Who's else is there?
Sir,
Ridhima,
I'm
are you?
here.
Okay, you're there.
So I'm here.
Sir,
O-
I'm here.
Okay. Ridhima, are you there? No. Akshay? No. I think Sai is not there, is it? So just we'll wait for 2 minutes. You're able to see the screen?
Yes, sir.
Okay. So we'll start after 1 minute. Let others join. I think there's one or two students missing. So we were explaining, I was trying to explain what is a capital protection fund. Okay. Just let me check if Sai has joined. Uh, Others have joined now. So I think now we have Vyom is there. Okay, I think everybody is there except Sai. So we can just start after a minute. Okay. So please listen it carefully and please watch the video again once I share it with you because there will be a quiz which will be on whatever we have learned today in the next time when we meet. Okay, fine. So we're talking about which fund? Capital Protection Fund. Everybody is there? Okay. Now let me see if I have put my recording on. Yes, it is on. Okay. Now, let's take an example of a capital protection fund. Suppose, there is a fund which has, received 100 rupees from all the investors. Okay. And they have invested into, because it's called capital protection fund. So the fund manager says that, whatever money which you have invested will remain protected so that you are not going to lose at all. Okay. Even after, 5 years of the scheme. Suppose this scheme is a close-ended fund, okay, where your money will be returned after 5 years. So what he's going to do is going to put, say, for example, 20 rupees equity and 80 rupees in debt, in bonds or something like that. Okay. So I'll just put it bonds. Okay. So where, he's put 20 rupees in equity and 80 rupees in a bond. Okay. Suppose the bonds are giving 6% return per annum. Okay. So which means 4 rupee 80 paisa per annum for 5 years. Suppose the scheme is for 5 years. So that means your bond will generate a return of 24 bucks. So that means 80 rupees will become 104. So even if the equity doesn't give you any return or you lose whole of your equity, you will get 104 rupees. Okay. And the NAV of the fund will be 104 in that case. But assume the return given by, say, equity is 0%. Okay. Which means the equity remains 20 as it is, or even it goes to negative. Okay. So if it suppose assume that it gives 0% return, then your NAV will be 124. So you put 100 rupees and you're getting 124 rupees back. So a return approximately close to about 6% or less because your bonds have only given return and you are getting, your principal is protected. Whereas suppose the return here goes to say 20%, in that case, it will give you NAV of 44. Now these bonds, these funds generally give you a return close to about 10 to 11% at the maximum, okay, per annum. Fine. So if you look at, the return here, so it will be, for example, we can just, add this to understand what is the return. Okay, so if we just add, the return of both the columns per annum, it is going to be 8.8%. Okay, suppose it gives you, say, for example, 25% return, then it will be 9.8. But usually these funds give around close to about 9 to 8% return, or maybe 8, 11%. But it all depends, how much money they have put into equity. Suppose they put 30 rupees into equity and 70 rupees into debt, then in that case, the return will go to 11% because then, you get, and the return even goes to 20%. So it will give you around close to about 10% return. Is that clear to everyone? Is there any question? I mean, what are,
Got it,
yeah,
sir. The mix of
Got it,
equity
sir.
and debt.
Haji, Teja, what are you saying?
So you are explaining the mix of equity and debt in the overall portfolio, right?
Yeah, in a capital fund, in a capital protection fund, in a capital protection fund, which is, coming out right here. If you look at, a capital protection fund, here it is, okay? Fine.
Right,
So
right.
these funds, the fund manager says that your capital will be protected. So that he's going to put money, major money into a bond fund and little bit into equity. And this fund will be generally a close for about 5 years. And after 5 years, you're going to get your return, okay? Now, if you look at, the here, say for example 5 years, these funds are giving you around close to about forget the first one, of course. There's no fund actually, it's all the advertisement, which is a flexi fund. So the fund which is going to give you is basically kind of a Nippon Capital Protection Fund is giving 16.6% in 2 years time frame. Okay, fine.
So
So these are capital. Now in capital protection fund, basically how does the fund manager ensures that the capital is protected? Anyone?
by assigning more of it into low risk securities like bonds.
Yeah. So, that basically protects your principal. Okay, good. Wonderful. So let's move on to the next one. Then there is something called arbitrage funds. Okay. Sai, can you read arbitrage funds?
Sure, sir. One
Here.
second. These mutual funds invest in both stocks and bonds. The focus is to take arbitrage position in stocks so that there is no impact of stock price change, but fund can generate fixed returns over a period from arbitrage available in price of stocks or futures.
Okay. Now, tell me, have you any idea what is arbitrage fund or what does arbitrage means? Okay. So let's talk about an arbitrage. Arbitrage funds. Okay. And then let's just go back and see once more. The arbitrage funds, okay? This one. Okay, so we're talking about this arbitrage fund. So any idea what are arbitrage funds? Anyone?
Sir, I believe fundamentally they are hybrid funds,
Okay.
and they kind of look at the price differences, which is perhaps how is this security priced compared to the rest of the securities which are of similar nature, and
Hmm.
we'll see if this is kind of low priced, and then they pick such funds or such securities.
So
Okay.
as per me, a stock or some security which is trading at, around 100. If we say it is trading in one market, it is 100, and in some other market, it's trading at 120. So
Correct.
the price difference between that, they want to take advantage of that. So that
Okay.
is arbitrary,
So who
Yeah,
was that?
mostly in
Yeah.
currency and
Yeah.
also in stock.
Okay. Okay. Fine. So, okay. Now just let me just give you some perspective about what are arbitrage funds. Basically, they invest both into equity and debt. Okay. Largely into debt, but less into equity. Okay. But now, how does the equity make? What does the equity understand? So please listen it carefully. So this is a little tricky. Okay. Now we have, a cash market and the futures and options market. So there are two segments in the stock exchange. Okay. When you look at the stock exchange, if you go to stock exchange, you will find there are two kinds of market. One is called the cash market and what is called the future and options market. Suppose if you want to buy a share, for example, Reliance, in the cash market it is currently trading at say 2700 rupees per share. Okay. Suppose you want to buy 100 shares of Reliance, 100 shares. So these are how much money you have to pay to buy Reliance 100 shares.
70,000.
2,70,000, isn't it? So this is what you're going to spend. Okay, so what will happen if you buy in the cash market? Your demat account, you should have a demat account, and it will say that you hold 100 shares of Reliance, and they are today valued at 2,70,000. Okay, say after 1 month, for example, the share price of Reliance goes to 2,770. Okay, so what is the return you have got? How much return you have got? This
70 rupees per share.
minus this. Okay,
2,000.
70 bucks. And if we calculate, it will be what sorry, I'll just put it, I'll add 270 to this. Okay, I'll add 270 to this. So this will become now this should become 270. Okay, and this will become how much? Plus 270. So you get exactly 10% appreciation. Okay, so this is giving you a 10% appreciation, isn't it? Okay, over the price of Reliance, which is 20,000, 2,700, and you will be actually making a gain of how much?
27,000.
27,000 over the capital which you have invested was basically this 2,70,000. Okay, so if you calculate your return, it will come to 10%. Is that clear? Okay. Now, there is another way that you can go to the future and options market and go to futures market rather than the option market. Okay. And you will find that, the same Reliance is trading at 2,730. Normally, either the Reliance futures, this is Reliance futures. Okay. Fine. This is, Reliance futures, we call it. We can call it F. Okay. So Reliance future is trading at 2070 in the futures market, whereas in the cash market is trading as 2700. Okay. Now it can even be trading at a lower than this price of 2700. So if the market is bullish, so always a future will have a premium. Okay. Fine. So now here also you can take a bet on 100 shares. Fine. Let's assume for a very simple reason that the future price is also 2700, though it will never be. Okay. Let's assume that it is the same in the futures market as well as in the cash market, it's same. Now, if you want to invest here 100 shares, you have to pay a margin money. Fine, which can be, just 20%. Okay. So which means, you have to pay, sorry. So it will be, like, so you have to pay only 54,000. In the cash market, you paid, 2,70,000 to get 100 shares. But in the futures market, you have to pay only 54,000, which is the margin money to take a bet in the futures. Okay. Now we are in the month of what? November. So you are betting on November futures. Okay. That is for 1 month. This will, on the last Thursday of November. So already, actually we'll take position in December because November is already over. Okay. So last Thursday of, December, suppose it happens to be, let's see. So it is last, Thursday is going to be on 29th. So on 29th is the last expiry day. So you took a position and you paid 54,000. Okay. You bought. So you took a, a long position in futures market. That means you got long on Reliance. Okay. So you paid, how much? 54,000. Okay. For December contract. Now, what happens is that, as you can either square your position earlier or you can even wait till expiry. Suppose the Reliance goes to, the same, it goes to 2970. Okay, fine. So you are sitting on a profit of how much? The same, 270. But the profit is going to be 27,000, but your capital invested is only 54,000, isn't it? So what is the return you're getting? 50%. So if the reliance goes up by the same percentage, of course you can lose your money also. But assuming that, if you have to taken a position in the cash market and reliance has gone to 2970, but in the futures market it has gone again to 2970. But here you have just put 20% of the money, which is the margin money. Okay. Say on 29th of December, if the reliance, closes at 2970, you will be sitting on a profit of 270 per share. So that means the same profit you are making. Okay, so this is, your profit. Fine. So you're making profit, but here you are earning 50%. Here you're earning 10%. Why? Because you are paid just 5 times lower. Okay, because margin was just 20%. So your profits have gone up by, 50%. But you can lose also heavily. Okay. So this is the futures market. Is it clear that if you are, but you will not have in demat account your shares. So you are basically, you will be getting either a profit or a loss, which will be either paid in cash or received in cash. So you will be making only a cash profit or a cash loss in the futures market. But in the cash market, you will be sitting on a profit of 27,000. If you sell your Reliance, you will be gaining 27,000 rupees. Okay, you have to sell to actually get a cash profit of 27,000. Is this clear? Okay. Is this part clear to everyone? Any
Yes.
questions, please, so that we can move on the arbitrage understanding. Is it clear, Prachi, Ridhima, Rupak, Sakshi? Say yes or no. Any questions, please ask Akshay.
Clear, sir.
So it's clear.
It is clear. So, where you are making more profit in terms of percentage, in the futures market or in the cash market?
The futures.
Why you are making more, return on the futures market?
So because the amount invested is way lesser than the cash market.
Yeah. So because you are investing just, 20%, not the 100%, in the cash market, you have to pay all the money upfront and the shares will come into your demat account. But when you are in the futures market, you are not paying all the money upfront. You are paying just the margin money and the similar kind of gains. Yeah, just नहीं नहीं कोई नहीं. So, here you are basically sitting on a 50% profit. Okay. So that is very clear. Okay. Uh, uh, Fine. Sai, is it clear to you? Vyom, is it clear?
Yes, sir.
Okay.
Yes, sir.
Now, let's take an example here. Let's take an example of Reliance. Okay. So, we have the cash market and the futures market. So, I'm just putting futures market. We are not putting the options market. So, Reliance is trading at 2,700 in the cash market. And in futures market, suppose it is trading at 2,750. So, this is, in the month of December. Okay, fine. So assume that this is 1st of December, or even if it is 30th of November, doesn't matter. So you are finding that, in the futures market, Reliance is trading at 2750, December futures, okay, because November futures are closed now. So the cash market today is trading Reliance is 2700. So what are you going to do? You are going to take two positions. You are going to buy in the cash market and sell in the futures market. So this is your position. Because you find Reliance in the cash market is trading at 2,700, but in futures market is trading at a premium. Okay. So if you do that, okay, you're going to buy, Reliance in the cash market, and the futures market you're going to sell at 2750, which means you will be assured of a profit of 50 bucks. I'll tell you how, but let's assume how much return you are making first of all. So you are making a return of, close to about 2%. So how much return you are making? 1.9% per month, because this is a monthly contract. Okay, if you want to just, just for the sake of, analyzing it, you're sitting on a profit of 22% return per annum. Okay, so how does it happen? Now, suppose it is December 29th. Okay, so in the cash market, the Reliance goes to 2900. Fine. So what is your profit? 200 rupees. But you have sold Reliance at 2750. Okay. So which means that you will be making a loss in the futures market. Sorry. So your net gain will be how much?
50 rupees.
50. Sorry.
50. That's the arbitrage.
Yeah, that is the arbitrage profit you have gained. Okay, so you have still made a 50 bucks. Suppose, the Reliance would have been gone to 2600 in the cash market. So you would be making, and the futures market, it is 2600. Suppose it closed on 29 December, both the cash price and the future price are the same on the last day. Okay, so there will be no difference because they converge at one price, because on 29th of December, which is the last trading day, all the futures settlements are done at the cash price prevailing in the cash market. So if suppose it goes to 2600, so you are making actually a gain because you have sold the stock at 2750, but the price is 2600. So the person to whom you have sold, he will give you 150 rupees. Okay. But here, since you have taken the stock at 2700, but now you have to sell it at 2600, you are making a loss of 100 bucks. So net gain will be always 50 bucks. So this is called the arbitrage gain. When you find that there is a difference in the cash and future market, which gives you a return about 1.9% after, just let me complete. After, suppose assume this is the return you are getting, suppose there is a, cost also involved. Okay. Suppose there is a commission or brokerage. Okay. Suppose the commission brokerage is 10 rupees. Okay. So in that case, the profit will get reduced to 40 bucks. Okay. And the same will be here also. So it will also go to 40 bucks. Fine. So you're still making 1.5% return. Okay. And suppose assuming your cost of your capital is, say only 10% or 1%. So you're still making 0.5% gain over your cost of capital. If you are using your own money, then you are making 1.5% return, which is 18%, kind of a return, which is a very good return. If you put the same money in a fixed deposit, you get only 6 to 7%. Now you please ask questions. Okay.
Sir, in the cash, so in the futures market, the contract gets expired on the specific day. But on the other side, when we are purchasing it in the cash market, unless we sell, it's not going to expire, right?
Absolutely, absolutely. So what we are going to do? That's a very good question, because all these questions will clarify everything which I have missed out in my, what I have said. So what you are doing is basically in the arbitrage position, you are taking two opposite positions. In the cash market, you are basically buying and you are selling in the futures market. Whatever positions you have taken today, just on the expiry day, you are going to reverse the positions to realize your arbitrage profit. Okay. So what we are doing is here, look at this. So you basically bought and sold. Now on the at the month end, you're going to just take the opposite position, which I missed out. So that is good. So you're now going to sell in the cash market and buy in the futures market. Fine. But in the futures market, you don't have to buy because you have waited until 29th December. So your position will automatically be, squared up. Okay. So this will be an automatic position that you have actually sold and bought in the futures market. Okay. So on the expiry, you will be, whatever is the closing price on that, the settlement is going to happen as if you have bought it. Okay. Now coming back to the screen. Okay. So whatever positions you take at the start of a month or any time in the cash market or in the futures market, you have to reverse your positions on the expiry day, okay, or on before the expiry day. Even you can do it before. So let me just take an example here, okay, just to complicate it further. Suppose you didn't wait for 29th of December. Suppose on 10th of December, okay, it was like this, okay. Suppose it was like this. Fine. So you were still, making a profit of, 50 bucks, okay, here, which was, 50 bucks profit, which is, 100 minus 50. So you could have, at this time, you could have sold your cash position and you should have squared up your future position. So earlier you sold, now you'll buy. The moment you buy at 2,800, you have all assumed that you have made a profit of 50 bucks. Okay. So even if you do it, you take your position off, that means you square up your position, whatever position you have taken in the futures market. If you have sold, you buy now, whatever is the difference will become your profit all the times to come. Okay. Now, of course, it requires a complete understanding of future and options market, which is a separate subject altogether. So I am not dwelling into that. But these funds generally take positions, arbitrage positions, by sensing that the future price is far ahead compared to the cash price, and it is giving them a return, almost like 2% kind of a return, which is more than their cost of capital. So they are making money on that. Okay. Now, since they have taken money from you, so their cost is zero. So whatever return they are getting is the return which is coming to you. Okay. So it is only an opportunity cost for you. If you have not put the money in the arbitrage fund, you would have earned say 6 to 7% on a fixed deposit. So they are earning you about close to about 24%. If they are earning 2% per month like this, they're getting you a 24% return per annum if they find opportunities every month like that. Okay. So this is a little bit, thing which you understand only well when you know the futures and options market fully well. Okay. So with a very limited knowledge, have you done your derivatives anytime?
No, sir.
No. So this is your final year. I mean, is the derivative coming in the next semester?
Yes, sir. In the
Yes.
last quarter.
Yes.
In the last quarter. Okay. Okay. So that's a very important subject and you should not miss it. Okay. Fine. So let's go back now to, and of course it requires a little bit more understanding. So I'm not going into more. I think otherwise we're spending an hour on explaining everything to you, and we'll miss out, the most important things which we are going to learn today. Okay. So future and options maybe some other day. Okay. So arbitrage funds. Okay. Now you understand what are arbitrage funds, because they are going to put money. They are going to take positions both in stock and bonds. Okay, particularly in stocks in the futures market or in the options market. If they find that in the futures market they are making a gain, okay, compared to the cash market, so they will buy in the cash market and sell in the futures market, and they will reverse the positions on the expiry day or before the expiry to realize that gains. Okay, fine. So then we have capital protection fund, conservative arbitrage, equity, dynamic asset allocation fund, and multi-asset allocation. Now here, basically what they are going to do, they are going to choose, either 3 or 4 asset classes, and they are going to put money. Just read, Sai. Or anybody?
These mutual funds invest in at least 3 asset classes with at least 10% in each asset class. So for a diversification.
Yeah. So they are going to put into 3 asset classes. They are going to choose stocks, bonds, maybe gold, maybe any other commodity. Okay. So they are going to put your money into various asset classes. Okay. Like let's look at, for example, let's look at, IDFC, multi-asset fund. Okay. So this is a IDFC multi-asset fund which is giving, which the expense ratio is 1.6, and they have, let's see how much return they have given. So this scheme has given around 17% return. Okay, fine. So whereas the category average is giving only 8%, so this is outperform all of the funds in multi-asset fund. And I think I have also put a lot of money into this fund. So now it's always better to look at the portfolio. Okay. So portfolio, what is the portfolio here? How much money they have put in equity market?
66%, sir. 66.8.
And yeah, and they have also put in future and options 0.03%. Foreign holdings zero. Okay, fine. So they have put money basically. I think in only in total. So number of stocks. Okay, in a stock portfolio. So this is stock equity. Okay, so detailed portfolio analysis. So they are actually holding, so this is basically, they are putting. So of course they're not invested in, other than equity, and they're not, given a complete picture. Okay, so let's go back. Okay,
Sir, 66.7. Just go back to that
yeah,
one, sir. 66% and 8% in debt, and then 24.92% in others. That's what it mentions up there, sir. Just above
where?
summary. Just above summary.
Yeah. Equity 66,
So if
debt
you click
8,
on
and
debt, it
others
shows
24.
what are the debt uh,
Okay.
allocations.
Fine. So they have actually invested into three kinds of classes of securities: equity, debt, and others. Okay, others they have not specified here. Okay,
Sir, if you click
so
on others, probably it will show you. Yeah.
let's see. Others means they are actually uh, TR TREPs and MF units. So they have invested in mutual funds of other. TREPs means what? Okay, just try to find out from the Google what does TREP means. Hello.
Uh,
Just can you call me after half an hour? Okay. So just try to Google what is TREPs. So what are TREPs? So basically these are treasury equipment. I mean, is it?
Sir, it says tri-party repo dealing system, tri-party repo system. That is.
Okay. Fine. Okay, I'll explain that. Maybe next time I'm going to explain that. So I'm just going to, I've not gone through it much, so I'll just, explain what are traps in the next my session. Okay, fine.
Yes.
So let's go back to, uh, to these funds, historical return. Okay. So now we have, what we have done is, we have covered, mostly the hybrid ones. So let's come to the solution oriented. Okay. So solution oriented are basically the children fund, retirement fund, and investment cum insurance. Okay. So here your money is put into three kinds of schemes are there. Children fund. Suppose you want to put some money for your child education. Okay. So generally these funds will have invest in three asset classes. Okay. Fine. So children fund. Okay. So just read what is children funds.
These mutual funds invest in stocks and bonds. These funds have a lock-in period of 5 years or till the child attains age of majority, whichever is earlier.
So I'll just repeat this. These funds, they invest in stock and bonds. So they are investing both in stock and bonds, and they have a generally a lock-in period of 5 years, or till the child attains the age of majority. Okay. So this is for people who want to save for their children, their education, and then there is a retirement fund. Okay, which they invest their money in basically for. They also have a lock-in period. Okay, they also invest in stock and bonds, and they have a lock-in period of 5 years or till you retire. Okay, fine. So we can just look at how much a retirement fund is giving you a return. Okay, just look at here. Let's look at 6 months again because 6 months have been phenomenal for the stock market. So they are giving a return of, let's focus here only. So which is the best retirement plan fund which is giving you a return?
SBI Retirement Benefit Fund.
And in 1 year's time frame it is giving around 13. So they give you around 13 to 14, and even look that Nippon is giving you around 23% return, or on a 5 year time frame. Of course, if you look at, because for a retirement fund to really understand well, so you must look at the 5 year chart. Okay, so a 5 year fund is giving you 14% return, SDFC. So SDFC seems to be one of the best fund. in terms of retirement. Okay, fine. So then, of course, then I said the third category is basically the investment come insurance, where it gives you investment as well as insurance. Of course, you should not never put money into these funds, according to me, because the insurance and investment should be kept as a separate, kind of a uh, this thing. So there is no fund here. Okay, this is just an advertisement because this is giving the same. So there is no fund which has come up which is giving insurance come investment. Okay, so what is coming is just basically a kind of a sponsored advertisement. It is not. There is no fund category called investment and insurance. Nobody has come and launched any scheme. Now we come to others. So others, uh, Sai, can you name these two funds? Can you read what are these?
So we didn't choose any of those. It is fund of funds and index funds or the ETFs. So I have to
So
choose one.
funds of fund, so there are two categories.
Yeah.
Funds of fund, so that means they are going to invest only in funds. Okay. So they are not going into stocks and bonds directly, but they invest into funds. Either they'll choose an international fund or a very good Indian fund,
Vanguard.
and they're going to invest. Okay. Just read now what is written here. It is now coming up on your screen.
These funds create a portfolio of other mutual funds. Investments in other funds is done to take exposure in international market or theme-based funds, which is like FANG,
Yeah,
NYSE.
yeah. Yeah, yeah. So they are going to invest into, in other funds, okay, or international, market, international funds, like, those funds which have invested your money in, Microsoft or Apple or other companies. So if you want to invest in funds of funds, now most of the funds of funds, they are into negative, coming into negative. If you look at, of course, if they look at a longer time frame, these funds have given let's look at, kind of, so they are giving, ICICI Bharat is giving you very good, okay, so 20%. So sorry, this fund, this fund is very good fund, which is giving 22% return, okay, so you can always look at, you can drill down what this fund is doing, okay, I've never done it, but I have understood this fund is doing very phenomenally a great, return to the investors. So this scheme has given you about 31% return in 1 year time compared to 30% given by uh, the Nifty. Okay, fine. So whereas the category average has given you a negative return. Okay, whereas this fund is there are very few funds which are giving return under this category. Okay, and just look at the portfolio. Let's look at the portfolio. So
Mutual
you
funds,
will did not.
TREPs, and net receivables, which means cash
Yeah.
probably.
Yeah, so that means they are invested into other funds, okay? So which you will not find, let's see if you can find a detail. I don't think you'll find a detail. Let's see if you
You
find a
have
detail,
detailed
okay?
portfolio analysis at the bottom, sir. Yeah.
Okay, so let's go on. Generally, the foreign funds, they don't give information, okay? If they're invested
So
into
the
foreign
fund
funds.
page, let's say, so I am in the Vanguard. So if we go to the Vanguard's website, they will give clearly what are the portfolio under
Okay,
which that fund.
can you show that? Can you show that? Okay.
Sure, sir.
Can you show it on that? Or
Yes,
can you share the link to the students
I'll do
on the
that, sir.
WhatsApp group?
Yeah,
So that's interesting because I was not able to find, the details about these funds. So maybe some other, fund house is giving. Okay, maybe Value Research might be giving. I'll just see that. So I'll stop sharing so you can share. Okay, yeah.
sure, sir.
Share the link on the WhatsApp
Yes, sir.
also.
Yes, sir. So the fund I'm talking about is the um, Navi US total stock market fund of funds. And if you dig down and see, it has 100% exposure to international mutual funds, and that too it is only one fund, which is Vanguard stock market ETF. And when
Okay.
you click on the scheme document, you will be able to
Sorry,
see.
Sai, to interrupt.
Are you
We
sharing it?
can't see your screen.
Okay. One second. Sorry. Hmm. Am I on, sir?
Yeah, yeah. I can see you.
Right. So this is the fund I'm talking about. Uh, it's a newly started fund, probably 6 months or 3 months so far. And
Okay.
this is the only sector that it invests. And
Okay.
under that sector, I mean, the companies, it says as Vanguard Stock Market ETF.
Okay. So they have invested into a Vanguard stock market ETF. Okay,
Right.
fine.
So
Fine.
if
That's
we
all.
go to
Okay.
Vanguard Stock Market ETF, so this is the fund that it is invested into, and it says that this
Okay.
is a blended equity portfolio, and you
Category.
see all the
Yeah. Yeah.
ratios, etc. Sir. And if we go down and
Okay, good.
specifically look at, it will also give us the companies that so there is a whole
Okay, like
file
Apple,
that we'll get.
yeah, Microsoft, Amazon, yeah, yeah, that's good. Of course, it's giving you a detail about, where all it is investing into, which international companies investing.
Right. Sir.
Okay, wonderful. So just share the detail of all this to on the WhatsApp group you have shared, I think,
Yes, sir. I've shared both the links.
ठीक है. Okay, fine. So you can just go through this, all of you, okay, because this is a category where, it's called fund of funds, where the money is invested and, into the exposure is into the international, companies. So this is a route through which you can invest into indirectly into companies like Apple, Microsoft, and Amazon, and other companies which are supposed to do well or supposed to do well in future. Of course, the last year was pretty bad for the US stocks. So I was finding that most of these companies have not done well, and they have a doubt, like, the Facebook was down by more than 60% or 70%. So most of these companies were not doing well. Okay. So now we will have a small break, and after, a break, we'll do some stock analysis. Okay. Fine. The last one. Okay. So we'll have a break, and at what time should we meet? Sai? It's 11:20. 11:40 will be okay.
Sure, sir.
So 11:40. So we'll come back and we'll do some analysis on stock market. Okay, fine. So this will be very interesting. So please join after you again fresh. Okay, after 20 minutes. So see you after 20 minutes.
Thank you, sir.
Okay, see you.